we're going to be learning about retracements and reversals. And whether you're trading Forex, whether you're trading cryptocurrencies, whether you're trading CFDs, whether you're trading in the stock market, whether you're buying stock, selling stock, all of this is the same. Okay? Because we're talking about reading prices and understanding what a chart is trying to tell you. Now, retracements and reversals are crucial parts of your knowledge base for you to make smart trades and understand what the market is trying to say. And the most important part is being able to pick out the difference between a retracement and a reversal. It'll help you make additional profit. It will keep you out of trouble. So the ability to point out the difference between a retracement or a potential reversal is a great tool to add to your arsenal. Many inexperienced traders, along with some of the most experienced traders, are still unable to detect the difference between an asset's retracement and potential reversal. So let me pop up a live chart here because I have something set up for us. Okay, so if you understand trends and price action, you know that price doesn't move this way. Most of the time, price is moving this way. But when price can either be trading sideways, like here, price can be in a downtrend like here, or it can be in an uptrend. A smart trader only trades with the trends, and there's many reasons for that. Okay, the biggest thing about trading with a trend is it takes a lot of energy, a lot of work for the market to start being pushed up or down. They just don't stop on a dime. You know, it's like watching a hamster in a cage, and you watch him turn that wheel around. But once he gets that wheel moving quickly in the middle of that cage, it just like he goes on forever. Something has to stop the market. Now, there are lots of movement in between. The market isn't as smooth as that circle, that little carousel in the hamster's cage, because the market's made up of millions of traders, and different prices have different significance. But a healthy trend, okay, should be moving in what we call pushes and eases. Now, you can get a push and an ease, a push and an ease. And just like you see here in this movement, push, ease, push, ease, push, ease. You can also have messy things, because price can be moving up without it actually really trending. And price can be moving up without it being a pretty trend or a qualified trend. Okay. When price is erratic, and even though it's moving up, that's also a crazy market to trade in, because we should always be looking for high probability trades. We should always be looking for the most clear-cut trade we can make. If the market isn't trending and you're not seeing a clear open path, why trade? There's a million opportunities every day. It's not like it's a one chance only. Now, tonight I'm going to use an example, and I don't have it already down pat in my head because I just read about it. It's got nothing to do with trading. I read yesterday actually, about tickets to concerts that musicians charge at their concerts all over the world. And this AI that is employed by the ticket agencies that sell the tickets. And it really upset me. It made me really mad. Because I'll tell you, I flew from China to New York to see Barbara Streisand the last time she performed live before she retired. I flew to LA to see Tina Turner the last time she performed. I went to Celine Dion in Las Vegas when she opened. Okay. Now, you know from those three choices how old I am. Okay, I'm up there in years. But when the tickets went on the market. Granted, they're hard to get, and sometimes you go to scalpers, whatever else. But I would be able to call a group of friends and say, "Oh, do you want to go to Tina Turner's last night at concert? The tickets are on sale, and we want to sit down in the lower section. They're $600 a person." And my friends would say yes, and I'd get online the next day and I'd buy the 5, 6 tickets, and they were $600 a piece. Now we all know that the airlines pricing is crazy. One day a ticket's $187, 2 weeks later it's $350, and then an hour later it's $144. And it would make me very, very, very upset when I would find out the person sitting in the seat next to me paid $99 for their ticket and I paid $399, and we're in the same seats in the same plane going to the same place. To me, that's not fair or logical. Now, it seems to be these ticket masters are using an AI, and the artists who are performing in their artist management, not the, okay, can choose to use what they call on-demand pricing. So if you want to go see, I don't even know who, the Dixie Chicks performing in Germany, in Berlin, and the tickets went on sale and the seats were $50 a seat, but there was a lot of people buying them right now, the AI would change all the prices online to $62. But then later tonight, when there was no demand for the tickets, they might drop the price down to $50. And it would be constantly on-demand pricing, like Uber does. Well, this upsets me because I don't think it's fair. Because when somebody sets a price, they set a price. I don't want to go in a retail store and look at a pair of Adidas, and when I go back, or Nikes, and go back next weekend, they say, you know what? We sold 5 of the 12 pair we had, so we're going to charge you an extra $100. But this does very much help us interpret the market prices, okay, and trends and reversals and retracements, because it's no different than that algorithm. Because let me see if I have an uptrend going on. It's just easier for me to explain to you with an uptrend. Not that it's any different, but it's just easier to talk about that way. Okay. Nothing. Okay. In an uptrend, and it's just the exact opposite for a downtrend. But the traders start coming in the market and they start buying. And as they buy, the price moves up, just like that ticket price or the Uber pricing. At some point, some of the buyers saying that price is too high, and they move to the sideline. Other people who were buying made their profit. Okay. Maybe I said, damn, I can sell those theater tickets I bought for a lot more money I bought them for, and I'll sell them and pocket the money and go the next night, or don't go at all. But they pushed the price up. At some point, the market gets too high for the demand of the buyers that are out there. And the price eases back down. As price eases down, those buyers who said the price was too high before, and so in their head, there was some price they were willing to enter the market. So I saw those tickets went up to $600. I said, that's too high. They dropped down to 5. I said, okay, let me grab them now because I don't know how many will be left. And I'm willing to buy. As I buy, and other buyers come in, the price pushes higher again. As the market says, wow, that's too high, they move to the side and the price eases back down. This is human nature. Okay? This is not CFD pricing and Forex trading. This is just human nature. Imagine you live in London. Okay? You take the tube home. but it's pouring down raining. So at some point you say, let me check with online, let me go on my little app on my phone, see what Uber's charging me for my ride if I take an Uber home. You're willing to spend 30 pounds to get home safe and sound and quickly. But right now, it's at 41 pounds because everybody is going home from work at 5 o'clock and it's pouring down raining, so the demand is very high. But you say to yourself, you know what? I got some extra work to do. If I wait another half hour, all that initial demand will be out and it'll be back down to 30 pounds. So I wait the half hour, the price goes down, plus the rain starts to ease back. Price is down, I buy again. Just got nothing to do with CFDs or Forex commodities. It's just how we function. Well, we can see this in our trading, but we don't know. And what we try to figure out is what is in that guy's head as to what price he's willing to go. How much will the demand be? And when will those other guys jump back into the market? Now, if we knew that, we could pretty reliably get our Uber at the price we want to get it, or get our theater tickets at the price we want to get them. But if I was the guy who didn't buy at 600, waited for it to fall 5 and said, no, I'm going to wait for it to go to 4, and it turned around and went back up and went to 7, I'm feeling like a sucker because I didn't buy them. But there's also a point when the demand really disappears, because what happens is, sure, everybody was anticipating this concert. They want to grab up their tickets because they've been talking about this concert for months and waiting for the tickets to go on sale. The next day, the other group of people bought it. The next day, by now, the headlines are covered with the Russia invading Ukraine. Everybody's distracted. There's no buyer, so the price falls all the way back down. Well, these pushes and eases, we know is what? Retracements. And these falls are reversals. You don't want to get stuck in a reversal, but retracements are good for price, because a trend doesn't go like this. A good trend is going to push up and ease, push up and ease, push up and ease. And if you ever learned about trends, we talk about higher highs and higher lows, higher highs and higher lows in an uptrend. Downtrend is the exact opposite. So what's a higher high? The price pushes up and makes a higher high. It made a high that was higher than the previous highs. It then falls down to make a low before it turns back up and goes back up. So this becomes the low. The next time price pushes up, it makes a higher high, which is higher than the previous high. But the low is a higher low because it never falls the low it hit in the prior move. If we ever break this lower low, this higher low, then we might be looking at a reversal. So in other words, push, higher high, ease, push. It couldn't achieve a higher high. We start to worry. Still stayed above a lower low, pushed again. Okay. Pushed. Still making higher lows. So the trend still is workable, but it's got some problems. But if you were in the market and say you had bought somewhere around here, would wanted to panic here and get out and then miss this entire move? Or because you hadn't seen a lower low and saw that this was still a reversal, a retracement, not a reversal, would you have wanted to stay in that market? So we have to be able to interpret these some way, somehow. So let's go back to my PowerPoint for a minute here. So let's start with some basic definitions. A retracement is a momentary reversal that often occurs during a longer trend. Unlike reversals, retracements show a continuation of an opposing trend within the targeted asset. In other words, the trend is moving up, price is retracing. And the word itself is pretty well, but when price starts to decline, it's no longer in a retracement. This becomes what? A reversal. Now, if we don't know the difference, we can get in a lot of trouble or we can lose a lot of profit. Because when we want to enter the market, we want to enter at the end of a retracement. We're never going to get that lowest point. But when price is pushed up and it's eased back down and you can see it then reversing to move back up, that's where you'd want to enter the market, because then you can capitalize on that entire move up as a making profit. But if it's a reversal and you jump in, you trade in the wrong direction. Or if you stayed in the markets, you have an open trade, you are in trouble because you're losing profits. So reversals are temporary changes in an asset's trend that occur over a short period of time. Oftentimes, these reversals can last minutes, hours, or days. It just depends on what time frame you're using. Reversals are oftentimes drastic and do not represent a long continuation of an opposing trend during the asset's price action, like seen in retracements. In other words, if you're looking at something in a long term, it might be moving up in a nice trend. But if we're looking this, and this is on our daily charts, so it's covering a long period of time. But in our, what happens here, it falls all the way down here. Well, if we were trading this in our short-term charts, we would see it as a reversal, but it isn't a long-term reversal of the long-term trend. The long-term trend is continuing up. This is just a blip. And when you're looking at a long-term chart, it's a little blip. When you're looking at it in a short-term chart, it's a big blip. Oh, there we go. Now, some people want to give definitions to retracements and reversals. They want to be able to formulate something so they can tell the difference. To be honest with you, I've been trading for a very, very long time. And retracements and reversals are something you have to feel in your gut. Now, I only trade with chart patterns, support and resistance levels, and trend lines. I don't use indicators. I use candles for my charting, but I don't use the standard definitions of tops and bottoms and spinning tops and spinning bottoms. I don't look at bullish engulfing and bearish engulfing. Okay. So there is no way to use, as far as I'm concerned, to use candles. Although the person who wants to give the definition can say that a retracement is when we have an indecision candle, and a reversal comes when we get engulfing candles or three white soldiers, three black crows. Okay, not so dependable. If you want to talk about volume, the fact is, in our type of trading with CFDs, we don't see true volume. You only get volume from the commodities if you're trading commodities with the commodity exchanges, and those are the contracts exchanged, or you get volume from the stock market. But what you get provided with your charts is an estimated volume based on what's been provided with the liquidity. Remember, in the currency market, the Forex market, there's no exchanges. There's no way to track volume. So the liquidity providers can formulate all the trades that are going through their liquidity pools and feed us a volume. Now that it's said that this volume reflects the overall market volume. Okay, you decide, but you really can't use volume. Money flow, you don't see. Chart patterns can help you. And as I mentioned, I trade from chart patterns. Short interest, we don't see. Okay, time frames doesn't make a difference. If you're investing and looking, or swing trader looking over a long period of time, and you're looking at long charts and you're looking at environmental factors, okay, and you see gold is trading up, but really for our type of trading, we only concerned with what's going on in the last 15-minute chart, the 1 hour chart, really not even a 2 hour chart. Okay, and fundamentals. We're always concerned with what's happening in the economics counter news headline, because they can screw up the markets, but they're not going to really tell us whether we have a retracement or reversal. But the fact remains, you only have 3 choices anyway. So whenever a price reverses, most traders and investors are faced with a tough decision. You have 3 options. Now, this is if you're in the market. But you're not in the market, you're sitting on the side. It doesn't really make a difference unless you're ready to enter the market. So one will help you decide when to enter the market. But the only decision you have to make is when price reverses, if you're in the market. And these are 3 common sense choices. You can hold throughout the sell-off, which could result in large losses if the retracement turns out to be a larger trend reversal. You can sell and rebuy if the price recovers, or you can sell permanently and get out of the market. But the fact remains, we have reversals happening continuously. You would never stay in the markets long enough to make profit. But by properly identifying a movement as either a retracement or reversal, you can reduce your costs, limit your losses, and preserve your gains. Now, remember what I said to you. You're never going to pick the ultimate top or bottom. We call this catching a falling knife. When price dips down and goes into a retracement, okay, we're not going to guess where it's going to turn around. We're not going to guess when to jump into the marketplace. We're going to wait for it to retrace and start going back up to give us a healthy sign we can enter the market, and this is a retracement and it's over. Okay. You're never, ever going to get into the very bottom or get out the very top. So please get that out of your mind. You want to find a safe place, a number ahead of time to enter or exit the markets. So keep in mind that our retracements are healthy. When we see a retracement and we see a trend moving with the retracements, we know this is a safe market for us to trade in. So remember, the market can become tired of moving in the same direction. It takes a lot of work and money to send assets higher and higher. When the price gets too high, buying pressure runs out, and that's when the money dries up. This is a little retracement. It's when the guy I told you sits on the sideline. When demand dries up, price begins to fall and causes the chart to go south. This causes the security to become less appealing to prospective buyers who believe the stock or the asset has the potential to move higher, but are waiting for a better opportunity. As the price becomes more appealing at a lower point, these buyers jump back into markets and recreate that demand. And what I just described is a retracement. I mean, it's really the basic fundamentals, but this is a good, solid explanation for it. Now, reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal occurs. And again, whenever you're faced with these, you only have the 3 choices. 1, hold the position. That's the best choice to make. 2, close your position. 3, or get out of the markets. Now, reversals can happen at any time. And this is the tricky part. You'll be looking at it and say, look at that. I've got a healthy trend. Everything is doing exactly what it should be. It goes into retracement, and blurb, it falls straight down and goes into a reversal. because a reversal can happen anytime. So we need to choose their best options. We need to figure out how we can see this. So we can use things like Fibonacci retracements, pivot point support and resistance, trend line support and resistance, chart patterns, or other strategies. So let's pop up some live charts here for you. Okay, now this is my teaching chart, but it also happens to be the chart that I deal with and work with. Okay, if you notice these green lines, blue lines, dashed lines, dotted lines, okay, these are my levels of support and resistance. They're not yours, they're mine, because support and resistance lines are individualized. And if you're not sure exactly what they are, you need to take a class in support and resistance. Okay. But I call it eyeballing. When I go back and look at my historic charts back, because once you put these lines on the charts at significant price points, they protrude into the future. And whenever the euro dollar is trading at this level again, those lines still will be on your chart and they'll still be significant. Fact is, the euro dollar hasn't been at this price ever. So these are all fresh new lines. So the reason that they're greens is because in my color coding system, my personal key system, green tells me there are brand new levels. Okay. This price up here, the purple dash line, tells me it's an older level. So it could be older by a month, but it's whenever the euro dollar fell down to 101, this level before. Now we can see push, ease, push, ease, push, ease, push, ease. Now, there is no price definition that goes with a trend. It's a series of higher highs and higher lows. So in other words, as price is falling down, as long as price hasn't jumped back up, jump back up, jump back up, jump, and even here, it stayed above the higher high. Going down, it was making lower lows each time it went down. Here's where it got in trouble. Okay. Got in trouble here. And what did we do? We got to push up and we actually got a high higher than this previous high here. But look what happened in response to our pre-existing. These were not drawn on here today. These were drawn on here a day, 2, 3 days ago when as price fell to this level. This was probably drawn on here a couple of weeks ago. But look at what happened. As price moved through these support and resistance levels, they would have helped us determine whether we were looking at reversals or retracements. They would have given us prices that were significant. Look how this held right here. Look how this held right here. Look at what happened here. This gives us ways to look at these price movements and helps help us define whether we're looking at a retracement or a reversal. So support and resistance levels are important. Then we also have Fibonacci tables. Okay. Fibonacci's technically create unique levels of support and resistance. And because Fibonacci chart is based on the prior move, the prior trend, and it extends out into the future, these levels were drawn on from when price fell down here. These give us our future levels for the current uptrend. And we can see how the price levels respected these Fibonacci levels as it was moving up. So we could tell whether we had retracements or reversals. But also, when we start moving up, we see push, ease, push, ease, push, ease, push, ease, push. And look at that. even though it wasn't pretty, you can see it with your eye, but you can see the higher highs and the higher lows. Always respected. Higher high, higher low, higher high, higher low, higher high. That told us we could have made some nice trades in here, and we couldn't have gotten out here, but we would have gotten out probably here. Okay. But because here it made a new high and made a higher high, but then we started making new lows, but we still didn't come below that low, but we couldn't get the higher highs again. So when we couldn't reach the higher highs, we know that this trend is in trouble because the market hasn't turned to a downtrend. But if I was in the market at this point, I would have considered getting out. So again, we're using, in this case, Fibonacci's. So we've used support and resistance. We've used Fibonacci levels. Okay, we can again see here, we have our support channels giving us support and resistance levels. And we're downtrend, 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 beautiful move. And then what do? We move into a full reversal. What happened? You tell me. Because this is how price moves. So as I said, and as I showed you, Fibonacci's are a great way to be able to interpret the difference between retracements and reversals. Pivot points. Pivot points come from a pivot point chart, but then a calculator, but then you can put them on your charts and they will help you because all of these prices are significant prices to that trend movement. And when they're not respected, they can tell you that trend is having a problem. Okay. And then there's major trend line supports, okay, which I just showed you on that third chart there. Chart patterns sometimes help us. Okay. I only trade triangles. Okay. Head and shoulders will help you see a reversal, but unfortunately it takes so long to develop that we don't see it in our kind of trading. Symmetrical triangles, asymmetrical. Okay. I say triangles are all triangles. They only tell us something when you have the breakout. But basically when we have a breakout to a triangle, if it breaks out in the direction of the trend, then we just went through a retracement. If it breaks out in the opposite direction of the trend, we're going into a reversal. So remember, technical analysis is the study of historical price performance to predict future price movements. There are three important principles that govern all technical analysis. First, price is not random. Second, price anticipates fundamental changes. And third, the relationship between price and time is linear. Therefore, price moves can be viewed on patterns in price charts. So different strategies have varying different degrees of success depending upon where the market is in a bigger time frame. Technical analysis of a strong uptrending market will show the basing patterns that are frequently broken to the upside, forming stair steps. So of course, as with any strategy, there's no singular perfect strategy that can always guarantee you profit. Naturally, this means you cannot rely on a strategy alone for profits because it takes time between each potential opportunity. But being able to look at a chart and read price action and tell when your trade is in trouble or the price trend is in trouble, or when you should be getting out of the market or into the market, whether you should be riding the market or not riding the market, or helping you to verify an entry point, can all be done understanding and seeing retracements and reversals. I don't draw them on my charts. My eye sees them automatically. And this is what you should be doing. So as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon or missing opportunities, holding on to losing positions and losing money and wasting money on spreads or commissions. By combining technical analysis with some basic identification measures, you are more than prepared and aware of the risk and can put your trading capital to better use. So if you do have any questions, please write them in the box, and I promise you somebody will send you an answer. Thank you very much for joining us tonight. I hope you learned a little bit. If anything, you learned a little bit Uber and theater tickets or musical tickets. Okay. But I hope you did learn a little and that you can apply this to your trading knowledge. Bye now.